Welcome, everyone, to another episode of The Everyday Trader. This is Greg. Glad to be with you on this day before the 4th of July. Excited to celebrate our national heritage, our national independence, or as the English would call it, our Insurrection Day, or when we all became traders, right? Eric, it's good to be with you again. Also, we are excited to have a special guest with us today, one of our instructors at OptionsANIMal. In fact, we just returned from a summit in Austin, Texas last week. It was good to see you again in person, Horace. It's also good to see you here on the screen.
Thanks. Yeah, no, that was a lot of fun. It was great to see you. It's been 3 years for me since I've seen you, so that was nice.
It has been a good time, and I'm excited to hear some of the stuff that you shared there and have a discussion specifically about this topic that is one that needs to be talked about more, and that is this topic of national debt. Before we get into it, Eric, I don't want to ignore you. Welcome.
Yeah, it's good to be here. Happy 4th of July, everybody. Be safe and celebrate and all that other good stuff. But I'm really excited to have Horace here. Horace, you've been an instructor with OptionsANIMal for how long now?
I think it's been 5 or 6 years now. And I was a student prior to that, going back to 2011.
2011. So you've been around. And I certainly remember you as a student attending online classes and also going to the webinars, and always really enjoyed talking with you. I think it's a really it's an honor to be part of the community that we're part of, because I think we attract some of the smartest people in the world. And I'm not as humble as you are, Horace. You're a very humble person, but I have, and I don't want to embarrass you, but I have tremendous respect for you. You're one of the smartest people I know. And one of the things that I love is you bring a different perspective, and you and I don't always agree on things, but I love that we can have an intelligent discussion on things. And I think good ideas come sometimes out of, we don't have conflict, you and I, but we have honest debates. And I certainly have learned a ton from you. You read a lot, you process things differently than most people. You kind of march to the beat of your own drum, and I mean that all as a compliment. And you bring perspective, which I think is very important. And you've been talking about this issue that I know for quite a while, and it's certainly, I think, something that's worthy of putting on people's radar. I don't think there's anybody listening to us that hasn't heard that there's a U.S. debt issue, but you've got some slides that we're going to walk through. These were slides that you presented at our summit in Austin, and we thought, Greg and I were thinking, hey, this would be really good to put on this YouTube channel and share with everybody else.
Sure. That was the topic when you guys were planning that summit several months ago. Things looked a lot more dire than they do today, frankly. So we came in there ready to talk about the end of the world. And
wait a minute, are you saying the debt picture has gotten better in the past?
The debt picture hasn't gotten better, but number go up. The S&P 500 has gotten better, and the NASDAQ has gotten better. So the narrative kind of shifted. But yeah, this was. I've been thinking about this stuff, and I'm not an economist. I just pay attention to this stuff, and it seems to me to be kind of the elephant in the room that should be kind of first and foremost in people's discussion about the economic situation we find ourselves in. And I don't hear a lot of people talking about it. And what really got me started on this was the notion that Jerome Powell could be like Volcker and raise interest rates, astoundingly in order to curb inflation. And the fact of the matter is that we don't have that room anymore because of what I talked about in Austin, because of that debt. And I see the Fed as constrained as a result of this. They don't, but I think practically they are. So, what I started with is just this slide from I think if this is the CBO, if you hit the first one, this is just fiscal year 2022. And it shows total outlays of 6.3 trillion, revenues of 4.9. So you have a $1.4 trillion national deficit. This isn't so extraordinary. This is how we run the country and have for the last really 40 years, with the exception, I think, of 3 or 4 years where we actually had surpluses. And so as we continue to build this permanent deficit, interest payments are going to rise. And anybody who's been paying attention knows that interest rates have essentially been zero or extremely low, really since 2008, 2009. And as we've seen the steepest increase in interest rates on record in this country through the actions of this Fed, that's really putting stress on the net interest payment that this country needs to make every year.
Let's just pause and back up here a little bit. So this green line is how much, or this green section of this graph is how much money we bring in revenue, and this blue, these blue and the gray are what we spend, right? So are you making this very controversial statement that if we keep spending more than we bring in, there's a problem?
Well, you could have made that case 10, 15 years ago, I think, and you'd still be waiting. And so, yeah, that's the case I'm making. But at some point, you trip, kind of an exponential function. And I have my thinking is that this is going to happen much faster than people think when we finally do run into problems. And I'm not sure we're not almost there already.
So the in terms of where we spend our money, there's three categories here. What are they?
So mandatory is primarily things like Social Security, Medicare. Half of the discretionary portion of this graph is military spending, which, with the exception of really the middle 1990s, when we got the peace dividend and you actually saw defense spending at least fall somewhat, we're back into an inflationary portion, and so half of that is military spending, and then the other half of that discretionary is essentially what we fight about, and it really doesn't make a lot of difference in the grand scheme. And then net interest, the total interest payments that the United States pays are significantly higher than that, but since we own in federal agencies like the Fed, et cetera, a lot of our own debt, the net interest payments about 0.5 trillion, or it was at the end of 2022. And if you remember, that's really when they began raising rates. So that interest payment is going to go up, not just as a function of increasing deficits, but as we need to roll that debt and refinance, we're going to encounter higher interest rates. And so that's really going to explode. And currently, if you go to the next slide, it's a known issue. This is the cumulative budget deficit for this fiscal year, 2023. We've already run up $1 trillion tab through May. And remember, last year it was 1.4 trillion. So 2022 is that pink line on the bottom. It was a good year. And now, as we're seeing, I assume tax revenues are not as robust as they were last year, given what happened to the stock market and income derived from that. And spending is really ramping up. And so we're looking at a $2 trillion deficit this year. Compare that to 1.4 trillion last year, you get a pretty hefty percentage increase. And some of that is going to continue to be net interest payments, growing net interest payments. So if you look at, go ahead, you got a question about this? This is a great site, by the way, the Peterson Foundation, for this type of information. None of this is original for me, but they do a really good job of laying this out without a lot of drama and just kind of factually.
Well, I was just looking at the lines here. I was looking at 2020 and 2021 that were exceptionally high, and those were, of course, post-COVID. And then it's surprising to me that 2022 is so low, and then 2023 is higher. Is that because of the rising inflation? Because of the Fed? Inflation rates are still hanging higher. The Fed funds rate is higher.
Honest answer is I'm not sure, but I think if you take a look at tax revenues for 2022,
okay,
those would, so the revenue side.
Oh, okay, it's a revenue thing from taxes. Okay, I see it.
Yeah.
All right.
And spending. It's not like we've curtailed our spending in any meaningful way.
No.
Right?
No.
So yeah. So the point is that it's not a one-off. This is getting worse. Certainly through the first half of 2023. Now
it's interesting. It's interesting with this as well, because I've seen this problem, like you said, for 15 years, and yet at the same time, you listen to the Federal Reserve right now, and they seem to not be concerned about this issue. In fact, they keep talking about, there was just an article just a couple of days ago. In fact, Nick Timmeros from the Wall Street Journal just tweeted it out today, a research article by the Kansas City Fed saying how we're going to have to keep interest rates higher for an extended period of time because they feel like they are barely starting to make headway against inflation. Just in Q1 of this year, they barely started to do it. A full year after they started raising rates, and it hasn't even been restrictive at all in all of 2022. So, yeah, where's this going? Maybe I'm jumping forward too quickly, but
and I think that's a really important point. And I don't know why they're doing this, but it seems to me that the notion that the Fed, I was really struck in the last press conference when somebody asked Jerome Powell this question, straightforward, will you finance and it's just no, just dismissed out of hand. The Fed is an independent agency, not my job. That's really a question for Congress. I don't think that's a really viable path. I don't think you can set the house on fire and claim it's not your issue. And essentially that's what I see them doing. And I don't know, I think a lot of it is the rhetoric is necessary, even if it's not based on reality, because you can't say this stuff out loud if you're on the Federal Reserve Board, I don't think. And if they announced that they were going to cut rates so that we could facilitate, what would happen to the markets? They would go through the moon, I think. And so, yeah, I don't think they have a lot of latitude in what they can say in public. So I don't know, maybe they don't actually think about it. Now, the chart here on the left actually comes from the Treasury Department. They published this in their annual report on finances in the United States. Usually, when you see the administrations publishing data, they try and gloss over the big problems and make them look not quite as bad. This just flat out shows us, and it's a long time, but that's not a sustainable path. And they say that themselves. Everybody recognizes this problem, but I don't think anyone's really willing to take it on. And the graph on the right is just national debt over the last 100 years. And that's not a linear path, right? That's becoming noticeable, I think, to anyone. It's not getting any better. So, there are several ways you can address this, I suppose, from a public policy point of view. You can do what you thought, Greg, which is raise taxes, which is a recipe for getting thrown out of office. You can try and cut entitlements, and you don't have to. You just look at France when they tried to raise the retirement age by 2 years. You had nationwide riots. You could means test Social Security. All of these things are kind of politically untenable in a country who runs on a 2-year election cycle. And then, the next big target would be defense. And I don't see that coming down in the coming years, given the geopolitical situation. So I don't think we can have a reasonable expectation that we're going to handle this particularly well, using either raising taxes, cutting entitlements, or curtailing defense spending. And that really leaves only a couple of paths. So what's the next slide, Eric? Let me see. So this one comes from probably my favorite website, which is kind of sad, but this is the St. Louis Fred. If your viewers don't use this, they really
so
should.
This pause on that just so people understand. You said it's your favorite website. I love it. This is from the St. Louis Federal Reserve's Fred database, which I agree, because there's so much data that's there, and if you want to pull up two charts on the same, chances are they have it. And I love Fred as well. So it's funny you said it's your favorite. You're not an economist, but we play one at work.
No, and we pay for this. You might as well, through your tax dollars, so you might as well get something from it. So that,
by the way, I got to throw in a completely different conversation. If you like Fred, you will love there's a website called baseballsavant.com, and it is like out of the world baseball statistics. I know you guys are both baseball fans, and some of our listeners, I'm sure you're baseball fans as well. But if you want to get into like the depth of just random statistics that are available out there, Fred is for our economist side of us, and Baseball Savant is for the baseball side of us.
Darn it, I closed it by accident. All right.
All right, well, that's good to know. I've stopped when we moved out of Minnesota, out of Minneapolis. I really have stopped paying attention to baseball. So.
Wait a second. Wait a second here. You're no longer a Twins fan, but you live outside of Boston. You're not a Red Sox fan?
We live in Western Massachusetts, Eric.
Oh, that doesn't count. That's not really. What is that? That's like
Boston doesn't know we exist.
That's basically New York, Western Massachusetts.
So the top graph here is just illustrating the growth in interest spending, net expenditures, interest payments. And keep in mind, this is just starting. It's been 1 year of higher rates. So a lot of what's driving that, it's not just deficit, it's that it's being refinanced at, the difference between, 2 and 5.5% is significant. And so that line is not going down as this debt rolls off and and our Treasury needs to refinance. So that looks awfully exponential to me. And the red line is just there for illustrations. This is defense spending. So you can see that they've touched before in the 90s when we were cutting back on defense, but this is not a trivial issue. This is a massive portion of what we spend as a country, and it's only getting higher. And then the bottom is just the federal debt as a percent of gross domestic profit and or product. And this
so this second graph is total debt to
GDP.
Okay.
So
before we hit the record button, I said, hey, there's other countries out there that are bad. And I'll share that list with people so you can see who we're among.
Now,
so this is debt to GDP. Here's the United States at 129% of debt to GDP. We got Japan, which we all know their situation, Venezuela, Sudan, Greece, Eritrea, Libya, Lebanon, Italy. Hey, there's the United States, Cape Verde, Bhutan, Suriname, Zambia, Bahrain, Cuba, Portugal. Just a golden list of countries that we want to be associated with. So maybe that 129, maybe we should take a look at that. I don't know that we're in such good company with that.
They can't, of course, print the reserve currency of the world. Yes. So I think we have a lot of leeway, but it's just there for me to show me that this isn't normal. And as our debt rises, if you're lending money to somebody who's continually going deeper and deeper and deeper into debt, I would think as a lender, you would require somewhat higher interest payments because you're taking on greater risk. And that's part of what I think I'm paying attention to with GDP. It was reasonable for people to want a higher interest payment if you're as leveraged as this country is. So that's going to impact us as well, I think. And I think if you take the next slide, this just shows who owns our debt. And so, about 2/3.
It's not China. Everybody says China owns our debt.
Well, they own a lot of it, but about 2/3 of it is domestic, and a good portion of that is within the government. So when you compare interest payments to net interest, I think this is what you're taking out, right? If Paul Krugman says this all the time, we owe it to ourselves. Who cares? Okay, but that's a non-trivial amount that's owned by other countries, Japan and China among the largest. And it seems to me, given the tensions with China, they're probably not anxious to continue buying debt from us at the levels that they were prior to, say the last 6 years. So foreign demand, I think, is I can only imagine it is softening. And what we saw happen in Russia, we essentially weaponized our debt. So that's got to give pause it's not a large portion, but it's a marginal impact, and that's going to increase borrowing costs. So the question is, as we need to finance this growing deficit, who's going to buy it? And I think the answer comes back to the left-hand side of that chart. It's going to be the Fed.
Well, and to go on to that point that you were talking about with Krugman and saying, well, we owe it to ourselves. Well, sure, but you tell me a pension fund out there or a state or local government that is owed interest by the United States government in the form of a bond payment, and if my local community, my local city government who's expecting a dividend payment, if the U.S. defaults and says, sorry, we don't have the cash to pay it to you right now, my city's going to go belly up. So will every other pension fund that's out there that's needing that continual cash flow. And that's why we will, the idea of default is, I know a lot of people say, oh, we'll just default on China and they won't care. Well, it's not who we're going to really default on. We owe it to ourselves, to use Krugman's line. We can't default on that, because then all of a sudden people who are depending on that pension check showing up in the mail every month, all of a sudden it's not there anymore because a pension fund goes under. I mean, this goes right to, we saw this happening in the UK this last year.
Right.
Was it this last year when the UK, a couple big pension funds started having risk of default, and Britain had to make the rough decision of basically devaluing their currency to be able to make those payments, and it sent a few ripples, particularly in overseas stocks. Didn't impact the whole global market that much, but if the global reserve currency, the United States dollar, has to do that, that's a whole different story. It actually brings back conversations, Eric, that we were having a year ago at the Rocky Mountain Economic Summit with Paul Ryan, and that there actually is maybe more talk than we're aware of the concern in Washington about the reserve currency status of the United States. I just think it's one of those things that, as a politician, you don't even want to talk about that in front of most people. So yeah, it's a
and they are beginning to talk about it. I think Janet Yellen said something about it in her congressional testimony. At least admitted that one day it won't be. So yeah.
Horace's other passion is cryptocurrency. So maybe Bitcoin, but
it's not. I wouldn't call it a passion, but a lot of what I read comes out of that world, and there's some really quite bright people out there and they're pointing out that essentially their main thesis, crypto I don't care about. Their main thesis for Bitcoin is that the current system we find ourselves in is broken, and you need to exit if you don't want to be a part of the conflagration that's coming. And nobody wants to see this happen. My problem with the people who are really pro Bitcoin is I think they're incredibly naive if they think it's going to be a smooth transition, and it's going to be messy if it ever happens, and who knows if it does.
So aren't you pro Bitcoin? I agree with everything you said.
I agree. I think that when you look at, from what I understand about most other cryptocurrencies, they're essentially beanie babies. I don't get it.
Right.
Bitcoin is, even Gensler points out that it is different. And I don't think it's, well, anyway, we won't go down that path. But anyway, that world provides some pretty interesting perspectives on the current fiat system that we find ourselves in. And
I think that let me throw a couple cents in, because I think the reason why this is important, and you brought this up before we started recording, was that if we're talking about this scenario where the solution to this debt crisis is the Federal Reserve essentially printing us out of it, allowing inflation to run rampant. Some people will say, but they don't want it to run rampant. They want to try to control this inflation, at least somewhat, to inflate our way out of this debt. That would, as you mentioned, essentially drive people to want to go to assets right now, because assets will also go up. And whether that's equities or whether that's real estate, whether that's Bitcoin, gold has been obviously the long historical one that people have run to in times of inflation. Is this relevant right now? Are we in the beginnings of this this debt spiral? Or is there a way to pull out?
Yeah, well, the final slide I have for you, I mean, and this is where it comes to trading for me. This is this is one of my favorite charts. S&P 500 in red and the total Fed, ECB, and Bank of Japan balance sheets in blue. I'm not an engineer, Eric, but that looks like a pretty good correlation. And so if your thesis is that in order to address this problem, the Fed is going to need to expand their balance sheet, that's going to drive asset prices higher, right? And it's going to have several different effects, but that's one of them. If they're going to try and inflate because they have to, the currency, then you want to get into relatively hard assets. Stocks are one asset class that works. But the other thing that people do talk about this, but this only benefits you if you own those assets. And so this has very real implications for the world we live in. As the divide between those who have wealth and those who do not grows, it's partially growing because assets are being inflated by central banks. And if you don't own them, like live paycheck to paycheck, you're standing still, if not, suffering the effects of inflation. So it's really exacerbating the social divides that we find ourselves in, not just here, but around the world as this plays out. And that has political implications that I think are going to make it even harder to address this. So it's not just, it's not just the money. This is a fairly dysfunctional system that I find myself in. But if those who say that the way out of this is to print and to increase your balance sheet, it's going to drive up asset prices. It's only when you look at how much, so your wealth will go up, you will feel wealthier, but it's only when you look at, did the share of the pie get bigger? The answer is really kind of no. You may feel wealthier, but in terms of percent of world, economic power that you control, you're probably standing still too. But it sure feels better when the markets go up.
So you painted a picture here. You kind of came full circle. It's kind of an ugly picture, but there could be good news for investors.
Well, it's good news. It's good news as long as you don't do the math, right? If the money supply doubles and my portfolio goes up by 100%, am I wealthier?
No.
Not really. So
it's better than
but it's better than not, right?
Not being in and having it go up 100%, and
Right.
now your wealth is down 50%.
Right.
Yeah, it
So
is
that's
scary.
Yeah, but the question is how long can they? I don't think how long can you kick this can, and I think the answer is a really long time. But when you look at the rise, and we talked about this a little bit beforehand, this is kind of, I think, the Fed's reflex now since Bernanke. Crisis, print money, and the most recent one is the regional bank crisis we had with Silicon Valley Bank, and it seems to me that a bank crisis that wipes out a great deal of wealth is a heck of a way to control inflation, and maybe letting that fire burn a little bit would have been the right move, but it was instant. It was within days that they established that the bank lending facility and have continued to kind of pour money, taking the assets of regional banks who want to get them off their books and giving them cash. And that number keeps going up week after week after week. And so when you look at whether the Fed has achieved a lot with their quantitative tightening, some, but not meaningfully. And that seems to be the reaction, is that they're going to print. So if you're an investor or a trader and that's the environment you find yourself in, that kind of explains why the NASDAQ might be up 35%, is people are beginning to sniff this out and they're, let's get on. I don't know, maybe that's going too far.
No, I think it's great. I think it's things like like we mentioned at the start of this. We need to be having conversations about this, because too many consumers, too many just regular everyday guys that go to work their 9 to 5, dump in their 3% employee match into their 401k, and hope that after 40 years of working, they're going to be able to live the American dream and retire, I think are living in a different world than their parents were. who did do that as baby boomers and are now retired and living in that world. We have this exponential growing debt that is not going away. It's getting worse. And so we have to address it. We have to have conversations about this on how to, both from the micro level, like how do I manage my own personal finances, my own personal investment decisions to prepare my family for something like this. If we were to go into a debt, not a debt crisis, I'm going to call it a currency crisis. If the value of the dollar gets crushed by QE from the Fed, if that happens, how do I prepare my family? But we also should be talking about the big macro picture too, so that we can have discussions and try to come to a solution and not have everything be so political in nature. Because how many times have you had this conversation with someone on the other side of the political aisle from you that we need to control the deficit? And immediately the right is going to say, well, it's because we're giving all this money in Social Security. We got to cut Medicaid and Medicare. There's too much given away. And on the left, the immediate answer is, well, we got to cut defense spending. We got to stop spending. We got to stop giving corporate tax breaks to, these Fortune 500 companies, the wealthiest people in the country. And although both of those arguments have truth in them, I think both of them need to be done, to be honest, to really, if we're going to do this from a fiscal standpoint, I think both of those have to be done. You're right. You said it. Politically, it's suicide right now for a politician to try to do that.
Yeah. And I don't see that changing.
I think we talked about it before the recording, and that a part of the inflation problem that we have has nothing to do with the Fed. A lot of what's going on has been the stimulus, which has been straight out of Congress. When you're handing money to people, they're going to take it and they're going to save it. They're going to pay off debt. They're going to go buy stuff. And, it helps people out in the short term. And, you and I remember having this conversation. The entitlements are what caused the inflation. You go back and you can see interest rates changing, but it's not until the entitlements really started to flow because of COVID that we really saw the inflation take off. And I think you made the comment, and it stuck with me, is that, are you saying we shouldn't have done that? And I'm saying, no, I'm not saying that at all. Because I can't imagine what would have happened. I really got to hand it to our leaders, the Fed and Congress, for, the incredible shock that we had to the system through COVID. We shut everything down and we came out of it. Everything's higher now. So we've done pretty well. So I'm not saying that we shouldn't have done that, but that, put us in the situation that we're in. Also, thinking in terms of what the Fed does, I think the analogy that I think of in my head is, what we see in sort of modern day forestry. And that is that we try to put out forest fires wherever we see them. I think we know that the earth, for hundreds of thousands of years, or maybe even longer, forest fires were natural and normal. And if you don't let a fire happen every now and then you get unhealthy situations where you've got some of the stuff that we saw in California a few years ago, where you've got all this tinder that's ready to just go up. And I think that's the picture that I sort of see here, is that the Fed is putting out all these little fires, and maybe what we need is a big fire. Let some stuff burn down. And we've got a lot of zombie companies that were able to limp along because they were able to get money from the Paycheck Protection Program or whatever. And you got these businesses that are probably unhealthy and not profitable and have been able to, stay in business because of the stimulus that they've received. And again, I see both sides to it, but there's definitely a negative side in that there could be a reckoning coming. The question is just when. And I look at, these numbers are so hard to get your head around, the size of the debt and how it's growing. It reminds me of a conversation I had with a girlfriend's father in college. And he was saying, Eric, you take physics in school. He's like, I have a question for you. The universe is expanding. If it's expanding, what's it expanding into? If the universe is everything and it's expanding, and the answer is you need different math. And I think that's the whole thing, is we need some different math here. And these sizes that we're talking about at debt are unfathomable, almost hard to get your head around. I think people probably agree that there's some breaking point, but I was taking a look at credit ratings, and the United States is not the best of the best, but I mean, we're one of the best, one of the highest ranked in terms of debt. We know that the S&P downgraded us, 2017 from AA or AAA to AA plus, and Fitch and Morningstar have us on a downgrade warning. But still one of the, I mean, we're like number 12, I think, out of 190 countries or so in terms of our debt. So the credit ratings are still there. And I would think that would be a leading indicator to see the credit ratings start falling. But I could be wrong there. I just this is something that's important, trying to get my head around and keep an eye on it. And I appreciate you talking about it, Horace.
Yeah, no, it's and it's not it's not something I lie awake at night worrying about, but I am curious as to how it affects the trading we do. And I think getting more and more convinced that this notion that money's cheap and they'll continue to debase is going to drive asset prices higher and higher. So yeah, it's going to be an interesting thing to watch.
So YOLO then.
Yeah, you only live once. You might as well.
Yeah,
exactly.
may as well.
It's yeah. So I don't know.
By calls on Tesla.
By calls on Tesla. Oof. That was a good one. I say oof because I had a bearish trade on Tesla last week. Didn't think they were gonna blow the numbers out and be up 7% today or 6.5%. Really nice move in Tesla today.
Yeah, it was the brightest star in the firmament today for sure. I don't know that. So.
Well, Horace, we appreciate it. Thanks for spending the time with us today. It's definitely been enlightening. Hopefully we come back. These are fun.
Love to anytime. My experience with OptionsANIMal has been fantastic. It's not just the education, it's being able to talk to the other community members. So I really appreciate it. And I'd be happy to. Yeah.
Cool. Well, thanks, folks. We'll wrap it up here. Eric, you have anything else you want to say before we close it out today?
No, I just want to thank Horace again for coming on. Like I said, it was a special treat. I appreciate you being here.
You bet. Have a great
feel free, folks. If you have questions for Horace or for one of us, post them down below. We'd be more than happy to respond to them. Don't forget to like and subscribe, and see you at the next one. Thanks, everybody.